And yes, we're get going. So welcome to Trending Treasury. I'm joined today by Luke Reeve, partner at Ernst & Young. I've been reading your bio, Luke, and very impressive experience in debt capital markets, in bonds, private placements, and credit. Just before we go, and actually getting a bit of feedback on the call. So the protocol for this call is please mute microphones. Don't mind what you do with your cameras, but we'll try and minimise the feedback going down the call. But if you do have questions, please pop your hand up as we go along, and also use the chat function if you want to ask us something. We're going to have Perry monitoring that, and we'll take questions as we go through. But we can see the attendees building up now. So yes, as I was saying, Luke is has got strong experience in debt markets, debt advisory, including advice to local authorities. So welcome, Luke. Thanks for joining
us. David.
I'm David Blake, Strategic Director at Arling Close, for those that don't know me. So we're going to dive straight in and ask you some questions about local authority funding, Luke. So here we go. We've got a very peculiar situation with local authorities, I think, where we have a very dominant public works loan board and debt strategies that are often dominated by government policy. And we're faced with a situation with consultation where we've got a cliff edge potentially on funding spreads. And that's sort of feeding its way into how local authorities are managing their debt at the moment. Luke, I'd be interested to hear your views on that situation and if there are any parallels with the other entities and organisations that you advise, and how they deal with that type of situation.
So central or local government intervention in funding markets has a distortive effect. Plenty of banks currently will be looking aghast at some of the government intervention programs that have come through COVID. The Bank of England's COVID corporate finance funding facility, for example, being certainly one element of distortion in the market, and perhaps they're social and moral questions here. Anytime the government reaches into funding markets, they're trying to soften what otherwise would be an incredibly sharp adjustment and blow. So it's perfectly socially justifiable, but it is a distortion. There are historic parodies. Social housing as a sector previously had access to government funding, but less so now. There have been changes in other quasi, what we would call sovereign-linked sectors. So those are anything owned by government or implicitly supported by government. We see that actually in some of our regional roles. For example, our team work as the debt advisors, retained debt advisors to both the states of Jersey and Guernsey, where on the islands they own many of the local utilities, so water, power, telecoms, and so forth. And so when you have government funding available to those entities, it distorts what private, in the public sector parlance, private capital, bank and global capital market funding can do. However, if we look outside of the UK, David, there are certainly agency functions in Germany, prevalent in Scandinavia, which allow local entities and local public funding to be accessed on what essentially is government subsidised rate. So that there are parallels, but the PWLB, while simple and easily accessible, it is to an extent distortive to funding other funding market alternatives. However, some of the adjustments that we obviously saw in the rate at the end of last year, for example, have the inverse impact on the market, being a shock in the wrong direction. And in that case, temporarily and possibly short, medium term, have moved the subsidised PWLB rate significantly wider than funding could be accessed from the private markets, very significantly wider, as a number of local authorities have already found to their delight, I suppose.
Good. Yes, on that, we've seen the municipal bond agency issue, Lancashire issue via the bond agency, and yes, we've seen spreads. I think the 5-year floating rate was around 80 over SONIA, and the 40-year I think was around 100 over gilts. What did you make of those bonds and those spreads, Luke?
I think they are good rates. We've for a long time have been the independent financial advisor to the municipal bond agency, so we've been a part of their market sounding and testing for pricing really for the last 8 years. That rate, they typically price off the markets, look for comps, in particular TFL, GLA, anything that is out there with a similar credit profile to the municipal bond agency. The view was that if the MBA became the prevalent interface for local authorities with the capital markets through sheer scale of issuance, number of issuance, and liquidity of those issuances, the pricing over time would come down and down and down to be much more comparable to some of the agency comps in Scandinavia, for example, Munifin and Kommunbanken, for example, who both trade at a fraction of the numbers you've just quoted. So one of the impediments for the MBA is that there is a structural premium for any investor understanding the MBA's structure, and then once you are in with other issuers, if you are not a benchmark size issuer in your own right, and to put a number on that, that's 250 or so £1 million would be viewed as a liquid benchmark. It's for index purposes on the investor side. If you're not a benchmark issuer and you're thereby combining with other local authorities to make 250 million of an issue between them, you're both tied to the maturity that the others may wish and also their timing for issuance as well. So it's great in terms of simplifying the documentation and access process. There is a bit of a premium. Obviously, the MBA needs to pay its way, and therefore there is a bit of a premium to going that way rather than going to market directly. However, if you wouldn't be going to the market directly, you would need to go down the private placement route, which at times has a premium for being illiquid, and at times it's very close to public market rates. So.
Interesting. Thanks for that, Luke. Yes, so we've got a situation where Lancashire were fairly ready to access the bond agency. They had a credit rating set up and that sort of benchmark size that they could then repeat. What are your views on credit ratings for the sector and for local authorities? Sort of looking at those size of deals.
I'm thinking of one finance director of a local authority in particular, and the look on his face when I told him that with a rating and therefore listed published debt, his debt would be traded and there would be a line on the screen like a heart meter at all times showing essentially a public independent benchmarking on the credit performance of that specific local authority. Which he viewed it therefore as an external performance metric, and he was less keen to have that out in the public domain. You asked directly about ratings. Ratings, they have great benefit in terms of transparency and governance, and therefore they can in themselves be a preventative measure to potentially overspending or not rigorous and prudent financial management, because one of the new considerations becomes what will the impact of our plans be on our rating. And so it's yet another, it's a controlling factor. We often say to clients, if you are planning on getting a public rating, you need to stick 2 teddy bears at your board table, one called well, typically they would be dual rated, not all, but and write the name of the agency, be it Moody's or Standard & Poor's, on that teddy bear, just to remind you that you've got a new stakeholder to consider at all times in all things that you do. That probably makes it sound very unappealing. On the flip side, of course, with public ratings becomes easier access to cheaper funding. So there is definitely a positive side to it. Our rule of thumb, and the well-known slide that our team have talked many a client through, is the rating is for life. It's not just for Christmas. A rating is something that you will have to maintain every year with annual updates. Multiple agencies, similar multiple updates, you will have to consider. And so our general rule of thumb is if you need to access the public capital markets in benchmark size, i.e. to go the public listed route, on certainly a, if not annual, biannual basis in benchmark size, so 250 million or more every other year or so, it's definitely worth it. It will get you easier access to funding once you've done your first issue and have your documentation set up. Repeat issuance is very, very straightforward, really, and therefore the rating makes that possible. If you are going to market in smaller amounts or less frequently than that, or want to do more bespoke and specific funding, again, things such as delayed drawdowns are particularly interesting in the local authority sector on the basis that a delayed drawdown is not a feature or available from the Public Works Loan Board. You cannot agree the rate today for funding that you'll take delivery of 2 years from now. In the public capital markets, you can do that. And so it is again, a rating is for life. It is something that will be a problem if I say a problem, you have to have out there continually being maintained and updated whilst you have listed debt with a rating as a requirement in that documentation, and therefore cancelling a rating can be in and of itself quite problematic.
Yes, I think I'd be inclined to agree with you, Luke, in terms of our discussions with clients on credit ratings. There is sometimes that sharp intake of breath and that warts and all assessments, and potentially a political tool for certain stakeholders in terms of the rating isn't universally appealing, and we are seeing a limited appetite for that.
I can give one very direct example that is similar entities, but not one who would be on this call. So, being the advisor to both Jersey and Guernsey, I can tell you that they are utterly obsessed with having the same rating as each other. The idea of one being downgraded and not the other, typically because there being crown dependencies, their ratings are inextricably linked to that of the UK. But if for whatever reason one of their ratings was to be lowered due to a matter not related to a wider macro event that impacted the UK credit rating, then that would be politically catastrophic for their equivalent of Parliament. If that were to occur, it would be very, very damaging.
Yes, I think we see that competition between neighbouring authorities across the UK as well. But yeah, interesting. So we've got a situation at the moment where local authorities generally know what the options are to them in terms of funding, in terms of forward dealing and private placements, municipal bond agency, going alone on public bonds and bank finance, all those other bits. But what we're seeing a lot of is that very cheap and readily available source of funding from their peers. So the funding spread for less than 1 year is super cheap. We're talking some rates are being agreed between authorities for say 3 months at 0%. And that's is a patchy market. It is prone to periods towards the end of the financial year where liquidity can dry up, and we did see a big spike in rates in March this year during the pandemic. But we do have a few that are quite comfortable borrowing on that basis and awaiting the policy decision. So what are your views on that, Luke, and when is that strategy appropriate?
I think it is useful as part of a portfolio of funding tools for a local authority. It would be the equivalent in the large corporate universe of large corporates' use of money market funding. Super cheap, however, cannot be relied on, needs rolling over every night, and therefore you are taking refinancing risk every evening, so to speak. Now, you may take a view that given the implicit government guarantee of or support for local authorities, it is extremely unlikely that a local authority would struggle to roll over that funding. However, there could be liquidity pinches, so that it's not a credit matter. The liquidity is simply not there, and therefore you need to replace that funding from other sources, which could be a problem at extremely short notice. There could be an issue occur with an individual local authority, anything ranging, well, essentially in financial difficulty for whatever reason that may be. And again, they may have difficulty rolling it over. I once had a very, very interesting theoretical and philosophical debate on this, essentially this issue, with a member of a select committee of government, speaking about the fact that governments, high-rated Western world governments, should only fund on overnight basis because it was cheapest, and it was there was no precedent for markets not being available to them. He even used the, rather bearing in mind that in his former life he'd been a hedge fund manager, please forgive me, he used the rather gross expression of rich people should only borrow short term, only poorer people need mortgages and long-term borrowing. We had then had an interesting theoretical debate as to the benefits, pros and cons of matching your assets, the useful or usable life of your assets with their liabilities, as many of us would do with our mortgages, to shorten and soften principal repayments over time, balance budgets and books and so forth, no different between a person and a local authority. His view remained that very, very high credits should only borrow very, very short term because it was unnecessary for them to pay more to borrow longer term. I'm less personally of that view, but that's on this ability to borrow from each other. That is, I think, a very helpful tool. It is, however, I would suggest a tool in the toolbox of funding, and I would suggest that perhaps only a certain amount of your funding as a local authority should be on that basis, given the lack of certainty and unquestionably you're taking refinancing risk.
I think you're right, Luke. I'd agree with that. It's a question of balance, isn't it, and exposure. And it's interesting the parallels you've drawn with corporates. And yes, I'm sure they will tap money market funds and other entities for short-term funding, but you wouldn't do your whole book on that basis, despite what your chum said. So, just in terms of percentages and when that's appropriate and how much you have short and how much you go long, is there a magic formula, or is it very much it depends what you're doing, your risk appetite and your access to funding perhaps?
I think there is risk appetite considerations. One of the entities, when Cambridge University were looking at their development campus, we were part of a debate among their essentially funding board, where at one end of the spectrum you had what we now knew was going to be a AAA rated credit, one of the few, now higher rated than the sovereign it sits in, therefore with unquestionably daily access to short-term cheap money market funds of exactly the nature we're discussing. At the other end of the spectrum, you could go and raise the full amounts that they needed for the development in the bond market long-term to reduce the amount of payments, the principal repayments over time, benefit from inflation rising in real terms, eroding the real quantum of debt that you had. That they had, and also having total funding certainty that they had all the money for the project in the bank on day one when they started digging, so to speak. And those are the bookends of your risk appetite. As it happens, unsurprisingly, for a 900-year-old entity, they went for the most risk-averse end of that spectrum. So they put all the money in the bank on a long-term basis first before doing anything. In terms of quantum, so it is very much down to risk appetite. There isn't a right or a wrong answer. I think one thing that the COVID crisis has taught many entities, be they governments or corporates or project companies, is that to be overly dependent on one source of funding can be problematic if that funding became constrained for whatever reason or overly expensive. Being financially covenanted is another issue, less a problem for local authorities, because certainly on the things we've worked on, we've managed to steer the issuer away from any need for financial covenants, but that can also obviously be a significant problem, as Rolls-Royce are finding out at the moment.
Sure. Okay, so it's been a a difficult time for large parts of the economy, most of the economy perhaps. But how do you think the credit story for local authorities is playing out in the perceptions of investors?
It's a very interesting question. I personally think that there are parallels in the credit journey that social housing has been on and higher education has been on. And when we look away from the UK, remember, many of the investors who would buy local authority issued bonds have many investments a long way away from the shores of our fair island, especially any that are US based, have a very different experience with their municipal bond market in terms of some of the credit issues that has faced. So UK local authorities are unquestionably starting by any international comparison at a very high credit point. It is almost certainly, however, as a sector on a declining credit trajectory. That does not mean it is bad. It just simply means that it is, as local authorities become increasingly leveraged, their credit does decline. They are starting from a low point, certainly by any international peers, and they still will always benefit from a significant amount of government support. However, lenders look at two things. They look at the transaction to default and then recovery. Now, government support obviously plays a role in recovery. It doesn't stop the deal getting into trouble in the first place, the issuer getting into difficulty in the first place. And so at that point where government support may be required, for any lender, that still is a major headache. So they do very much look at both likelihood of probability of default and then support and recovery. Overall, however, we have seen during COVID two things happen. Firstly, there has been a flight to quality. So most investors have moved significant amounts out of the equity market as dividends were switched off by companies to protect cash. That money typically gets redeployed into the bond market because it's liquid and easily accessible. There are, of course, other asset classes, be they currency, commodities, but they were immensely volatile in the early parts of COVID. So redeployment into the bond markets, and to be quite honest, in moments of high economic stress, investors put their money into assets where they can essentially sit on their hands, and therefore government or quasi-government bonds and high investment grade corporate bonds. So bizarrely, local authorities would have seen, even though it was a period of great stress, credit spreads would have actually started coming down potentially after initial spike moments. They would have aggressively started coming back to close to where they were, point number one. And that can then be added, that's the credit spread, to, of course, an environment where the underlying risk-free benchmark is being highly bid as well, due to everybody wanting to put their money somewhere safe, and even, well, gold being the final place of safety, one of the final places of safety. They put their money into government paper, thereby driving up prices and yields conversely down. So overall coupons actually falling for local authorities. So it may sound completely counterintuitive that, while overall people would recognise that this is a period of immense government spending, but overall for local authority credit profiles they've had to maintain and deliver more services than ever before in areas that they didn't necessarily have to, such as delivering basic food and so forth to residents, as they've had to take on more in a period where they have had potentially more declines, or significant declines in some cases, in revenues from everything from car parking to other things. And meanwhile, the credit quality of their implicit underlying credit supporter, the UK government, has also been declining, as our Chancellor has been levering up to soften the blow to the economy and individual families of COVID-19, I think quite rightly so for the most part. So it's a bizarre story that actually borrowing costs are sort of trickling downwards for high credit, such as, even though unquestionably the credit dynamics are weakening at the same time.
Yes, I think it's relative, isn't it? It's all relative. Okay, governments and local governments are going to need to borrow more under more pressure. But you look around at the other parts of the economy, which are suffering greater strain and maybe have less tools to adapt to that. So yes, I think it seems logical that local authority credit is well supported, and also I think it's been great to see the level of support coming in from central government to help them through this difficult time. Go on, Luke.
I do have actually a different another point to make on a similar journey. When social housing first started using the bank and into global capital markets, primarily the sterling bond market and private placement market, but not exclusively those. And similarly with higher education, I remember 12 or so years ago sitting with then the head of this entire sector team at Barclays, who would have encapsulated within his universe of lending higher education, local authorities, and social housing, and him telling me at that point they had the entire higher education sector rated AA, i.e., as a bank, they saw no credit differential between Cambridge University and, I won't name and shame, but I'm sure we can all think of a very small, low ranking university. I mean, clearly that's bonkers, but that was the position, and it was based on the implicit support. If you roll forward 10, 12 years, we're now sitting in the place where, yes, you have Cambridge and Oxford sitting on AAAs, and we've got EY's restructuring team working on 5 universities currently. So I think we can all agree there's quite been a significant opening up of the credit spectrum of the sector. Social housing has been on a similar journey, albeit at the larger end, because of course they have an enormous tapering of very small residential providers. Of literally thousands of several, 1 or 2 units. In local authorities, I think that credit knowledge is beginning, and we're beginning to see an understanding on the investor or banking side, on the credit side, that there are significant credit differentials between different local authorities. So whether you issue, and this is perhaps one of the complexities the MBA faces, especially, so Lancs obviously went as a single issue, it's nice and clean, it's got its own rating. When you are teaming up with other local authorities in any aggregation of credit is like water, it falls to the lowest point. So if you are in an issue with 3 other issuers, and 2 of them are significantly weaker credits than you are, then by default you're essentially going to be subsidizing them, which is one of the tricky parts of that structure. So I think it makes great sense in certain ways, like all things, great solutions. It's also got some considerations to it.
Understood. Well, thanks for that, Luke. Well, we haven't been inundated with questions as we go through, so I'll ask you one more, Luke, and very quickly as I'll try and wrap it up for past. But we mentioned private placements earlier on, and the credit spreads and how they compare with the public bonds that we've seen the MBA and Lancs issue. What's your take on that, Luke?
Well, those public bonds are helpful in that they provide, so we advised the London Borough of Brent on a transaction that's publicly announced back at the end of last year. And the comps at that point, well, there wasn't the Lancashire transaction for credit comps, so that priced where it did, which was a fantastic transaction for them. Today, if you were redoing the same transaction, absolutely the Lancashire transaction for the MBA, the long dated bond, would be a credit comp for that. And so you'll be positioning their credit either better, or any issuer's credit will be placed in the context and compared to that of Lancashire, which has got its rating, of course. So you would price either inside or outside on a relative value basis, similar to, frankly, if you're selling a house, I'm afraid, no different in principle to it. It would be compared to the one that's recently or is trading in the market and has a secondary bid on it. So I think spreads in the private market versus the public market do typically command what is referred to as an illiquidity premium. In theory, a public bond is liquid and can be traded. However, that having been said, I think we can safely say, particularly having just been through a period of stress with COVID, most high-grade long-dated bonds are very tightly held. They're buy and hold investors, even in the public market, and so there's very little secondary trading. So frankly, that illiquidity premium is pretty de minimis, but in a normal day could be anywhere between 0 and 5 basis points, so not not significant, and potentially none at all in the private market. There are even times where you will have investors in the private market with specific, because they're asset liability matching businesses, they may have a specific maturity where they have a mismatch in their portfolios, i.e. they've gone and sold lots of insurance policies with 36 years remaining and have nothing in the 36-year bond pot on the other side to pay those policies. So they may actually bid inside the private market to fill a pot. An example of that would have been advising the M25, or the project company that owns the M25 PFI, refi several years ago, where it was an asset of, obviously, everybody knows, our nation's favourite traffic jam. However, given the size of the offer, it's the only time I remember Legal and General bidding. The transaction was only for £790 odd million, and Legal and General bid £1 billion. They bid the entire thing simply because of the maturity. They had a particular need, and they were savagely inside the rest of the market on pricing to try to take the entire transaction, and that was just asset liability matching.
That's encouraging anecdote there, Luke. Thank you very much for that, and thanks for your time this morning. Thanks for coming on and talking debt diversification with us. Just a couple of things to highlight. We are sending out a questionnaire following this session, so we'd love to get everyone's feedback on trending treasury and any improvements we can make on that. And we will have a session coming up next week on commercial property that's on your screen now. But thanks again, Luke, and we'll catch up with you soon. Thank you, everyone.
Thank you very much, David.